I'm Wendy Desabé from St. Thomas in the U.S. Virgin Islands. I currently live in Miami or wherever my passport lands me. I love supporting others in learning how to live their best lives.
I'm Derek Lumpkins, a Boston-born globetrotter and photographer with the soul of a polyglot.
As lifelong friends, we're constantly talking about history, the arts, missed opportunities, and the road less traveled.
Welcome to Things They Don't Teach Us,
a podcast about life's tips, tricks, and insights.
Welcome back to the USA.
Woohoo! Yay, I think. I don't know. I'm in New York. I'm in New York. So, there's worse places I could be. I won't say where they are, but if you know me well enough, you know where I'm thinking of already. So yeah, it's not terrible to be back.
Well, I'm still in sunny Miami. It is bright out today.
But you said it was cold.
Yeah, for Miami, this morning it was like 62. I mean, I clutched my pearls.
I'm literally half the world is like, that's warm. That's summer for us. Literally half the world.
Yeah. Crimea River. But I know but for Miami, it's cold. I mean, people are running around with their fleeces and their hoodies on.
Well, they're also drinking champagne and their mimosas. So, I don't really feel so bad for you guys.
Only tourists do that. The rest of us don't.
Oh, okay. Oh, you have your vodka shots. Mm-hmm. So, anyways, seeing as how I'm in New York today, I think it's a perfect coincidence for today's topic, which is the things they don't teach us about the stock market.
And finance, too, in general.
Yeah.
Yeah.
What do you know about the stock market?
I know what I've watched on CNBC. I actually know how to read the little ticker thing below, which is a lot. It's surprising. I mean, I know it involves our retirement funds and how you can make money from it. But, to tell you, be well versed in it, do you know more than I do?
I know different things than you do. So, there's the bull market and the bear market. So bull market being when you're supposed to buy or hold, and bear market where I guess you're supposed to sell or where stocks are going down. And then there's the stuff you see on TV. So, I don't think it was The Wolf of Wall Street, but it was this one movie where they said greed is good. I think Michael Keaton, I forget. But it has that aura of like the greedy Wall Street capitalist taking all the money and investing it. Yeah, so it kind of has that aura to it. Or there's an HBO show out. I should remember the names of this, but where there's all these kids who are working in a finance brokerage and they're all on drugs at night and they're trading stocks by day. So, there's also that stereotype as well. So, I'm sure today's guest will clarify all of that. Maybe he will verify all of that. I don't know. We'll find out. True. Yeah.
Well, our guest today is my neighbor and friend, Mr. Silas A. Myers. Silas is CFA and co-founder and CEO of Mara Vista Investment Partners, a $30 billion Los Angeles-based registered investment advisor focused on domestic and international large-cap public company investments. He serves as a portfolio manager for the firm's focused and strategic growth strategies and has 33 years of investment and portfolio experience. I'm going to tell you right now, Silas probably has one of the most impressive resumes that we've seen, at least I've seen, and it's really very well. I mean, it's impressive, makes me think I haven't completed much in my life. He has a BA in psychology and an MBA, both from Harvard University, go Boston. He's also, I'm sorry, I couldn't help it. He's also on the board of trustees for Big Brothers and Big Sisters of Greater Los Angeles, where he is the former chairperson of the finance and audit committees, which I thought was very impressive. And I mean, he's got like awards and accolades and all this other great stuff.
Thank you, guys. That was a heck of an intro. I don't know if I deserve all that, but
no, you do. Man, you've earned it.
You worked hard for all of that.
Yeah.
By the way, that show is called Industry on Max.
Yes, thank you. That's what I was thinking. And exactly. Oh,
so you worked in investment banking and sales and trading and all that stuff over the years. It was not really that close to reality, in my opinion.
Well, there's no drug-infused orgies in the.
Well, there's some of that, I'm sure, but it was the funny part was just all the drama behind the characters and how people talked. It was like, that's not how it goes, but it was entertaining.
I'm disappointed.
What about the whole "greed is good" speech from that movie? I can't remember the name of that movie. Do you have people?
Oh, Wall Street. That was Wall Street with Michael Douglas.
Michael Douglas, yes.
Yeah, that movie came out when I was in college, and I just remember all of my friends when we were watching it. Everybody was so fired up about it. Like they loved that. I understand what he was saying, but I think that his delivery was probably a little bit over the top.
Okay.
For
So
an
you're busting all the bubbles. You're busting all the myths behind the fictionalization of Wall Street. So set us straight. Like, what should we be thinking about? As lay people who don't work in Wall Street, what is it like? What's sort of like a day-to-day life like?
It starts fairly early, depending on where you are in the world. The markets in the U.S. open at 9:30, but you probably get up a couple hours at least before that to kind of get a sense of what's happened overnight, what's the news of the day, what's happening with the bond market. And usually you just prep for a little bit and then the market opens and you go to work. Either, depending on what you do, like for me, for instance, we manage institutional accounts for big institutional accounts, and it's just a portfolio of stocks. So we're doing homework on all the businesses to try to understand their fundamentals, so we can try to get an edge on when to invest and what the price of that security is worth based on free cash flow. And just to give, I'm probably talking a little bit high level, but I mean, basically a stock is a percentage ownership in an operating company. And what that entitles you to is a percentage of the earnings of that business. So that's how we're able to determine what that business is worth, because we forecast out what those earnings will be, what our percentage of ownership is, and then we discount it back based on a rate of return that we think the stock needs to generate. On average, the S&P generates it's about 8% annualized a year over the past 100 and change years. So the objective of people like me is to outperform that over time. And it takes a lot of work and due diligence, and it's very competitive, but can be exhilarating. And the reason I chose this business is because I felt like I would be basically judged on my returns and merit. It was more about being able to give clients good returns as opposed to I'm a black man doing this business. So I thought green was much more powerful than anything else. The color green is more powerful than anything else.
Ooh, what's that?
Sure.
Well said. I
Yeah.
like that. No, you've actually explained it very eloquently. And here's a better question. So why should people care?
I mean, listen, at the end of the day, we're all responsible for our own lives and financial wherewithal. And one of the best ways to create wealth over time is to invest in stocks over a long-term period. I mean, there are so many things that I know now that I wish I had known even 20 years ago. Certainly when I got out of college, if I had known a little bit what I know now, things would be a lot different, a lot sooner in my life, because ultimately, if you start young, you can really amass a nice nest egg earlier in your life. And it's all about essentially taking a portion of your earnings after taxes and after all your expenses. And I think what people should do is every single month invest a small amount of money into stocks. And stocks can be through ETFs or individual names, mutual funds. Ultimately, I think these days, as an individual, it's too hard to figure out which stocks you're going to outperform. So it makes more sense to just buy an ETF that mimics the market. But if you do that over the long period of time, you compound that out over years, and it really builds up quickly.
For those of us that don't know what an ETF is, sir?
Wendy? An ETF is an exchange traded fund.
Okay.
So it's essentially like for the S&P 500, which is the market, and basically people believe the market in the United States is the S&P 500. It's the top 500 companies in the country. Ultimately, there are many more stocks than that, but those are the top 500 in that index. You can essentially buy the entire index through an ETF. Either through Vanguard or BlackRock or something like that. And you can actually automatically invest in it through your checking account every month and not have to think about it. That's what I think people should be doing. And also maxing out 401ks as well. People should be investing in their 401ks, maxing out if they can based on their budgets, and trying to get the employer benefit as well. So sometimes the employer contributes, and that really adds up over time. Like one of the things that let me ask you guys a question. This is something I ask people because I've done some seminars and things at colleges and so forth that talk about personal finance. Here's a question for you. I mean, you may know the answer to this because you may have been asked before, but if you take a penny on the first day of a 30-day month and you double it every day for 30 days, how much money will you have by the end of the month? So if you compound, so it's 1 cent and then 2, then 4, then 8, 16. At the end of the month, how much money do you think you will have?
I need
Can
a
I
little
use
bit
a
more time for
calculator?
that.
No, you have to think about it and guess.
I'm gonna guess that it's probably in the thousands, maybe not the tens of thousands, but maybe close to that.
Okay, Wendy?
It's a penny, so you're probably talking I can't even know. You're talking about maybe a couple dollars. But still,
All right, so
every month adds up to a couple dollars every year, blah, blah, blah. Yeah, I get it.
So essentially, you're compounding a penny at 100% a day for 30 days in a row.
Mm-hmm.
This is the lesson I like to give in compounding interest, and this is what owning stocks over a long period is all about. Because you build off of that same base every year. So if you have $100, you have next year. If it's 10%, you have 10, and then the next year you have $111, and it just compounds off of that. So the answer is 1 cent doubled every day, so 100% gain every single day for 30 days, $5.4 million.
Dollars?
Yeah.
American?
Yeah.
Wow.
That is the power of compounding interest. I mean, you can. That's what really fascinated me about investing. It's one of the wonders of the world, and people don't really understand it. But if you have the temperament and the mindset to be disciplined, that's how it works. And I think even people who aren't necessarily, traditionally rich or wealthy can actually do this and have real money set aside over time. I mean, I'm trying to get young people that I meet to do this because I think it's really important. To create wealth for yourself, a generational wealth or family wealth is to do it this way. This is one of the ways to do it.
Yes.
So the inner skeptic in me has this next question. So you mentioned that example of, doubling a penny every day for 30 days, but what are the odds of that actually happening?
Oh yeah, no. That's just an example. You're not going to get, nobody's going to get 100% a day, but I'm just but over years, you get 10% over years.
Mm-hmm.
It really adds up. I mean, one of the accounts that our firm started in 2009, call it 180 grand, and now it's like 1.5 million over the past 15 years. And this is slowly coming with no additions to the capital. It's just compounding that 180 over the course of 15 years, and you ultimately have a good amount of money to set aside. And the problem is people don't have the discipline to not tap into that money.
Mm-hmm.
And some people have different life circumstances. Something happens, something comes up, you have an emergency use for it. But if it's possible to do that over time and not touch it and just automatically do it, there's real benefits to that.
I also think
And
people.
it's easy now.
Pardon?
It's easy. It's easy to invest now. A lot easier than when I started. Between having an online account that has 0 commissions, or go on Robinhood and do it. It's so much easier now to invest. You can basically be investing while you're on the subway.
Well, that was going to be my question, because I think people think when they think of investing, like, I need a lot of money to get started.
You don't. You can start investing $100 a month, $50 a month, whatever you have.
Yeah.
When I was in my early 20s, I was putting away like a couple of $100s a month over time just to try to build up some capital to go to grad school.
Mm-hmm.
And it built up a nice little nest egg over time. So it doesn't take a lot of money to get started, and it doesn't take a lot of money to compound a bigger account over the course of years. But it's about being patient, and some people struggle with the patience part.
So there's a couple of acronyms I would like you to explain. So you mentioned the S&P 500. There's also Nasdaq. There's the Dow, which is not an acronym, but it's short for something, which people may not know. And then there's also REITs, which is something that I've been seeing more
REIT?
and more often. A REIT, yeah. So
Yeah.
can you just sort of explain those things, because people may be hearing these things in the news or just generally, and could you just explain what they are and why those
Yeah, I mean
differ?
they're called indexes. The Nasdaq is basically high growth businesses. It's got its own exchange, just like the New York Stock Exchange. So there's New York Stock Exchange and the Nasdaq, and those are basically exchanges where you can get quotes on different stocks. Typically, the Nasdaq's the smaller, higher growth businesses and technology related businesses. So you'll see like Nvidia and Tesla and so forth that trade on the Nasdaq.
Mm-hmm.
The Dow is also an index. It's 30 Dow Jones Industrial, 30 names. It's basically a snapshot of the U.S. economy. That one is a bit more antiquated because the how much the Dow goes up and down is predicated on the actual prices of the stocks, not how much they move. So if you have a stock that has a $200 price and it moves the Dow more than a stock that has a $20 price, irrespective of the market capitalization of the company. So people don't really use that. That's why they use the S&P 500. A REIT, or REIT, is a real estate investment trust. And essentially what that is it's a publicly traded real estate fund whereby you get the cash flow from that real estate is taxed at a much lower rate, so you can pass on the income to individuals. So don't really do great relative to others that have bigger earnings growth because of that tax advantage. But a lot of times the returns are pretty good because you get high dividends. Dividends are basically a portion of the earnings that a business pays out to shareholders. So for every share, you might get $1 dividend a year or something like that.
Mm-hmm.
Real estate investment trusts pay out higher dividends because they get taxed less, so they have more money to send out to investors at the end of the quarter.
If you were to choose between an ETF and a REIT today, where would you lean?
So basically, I would say be diversified. Do some of both. And you can there are ETFs that also mimic REITs as well. Like there are ETFs that you can buy, the real estate portion of the S&P 500, which has a similar characteristic as the REIT. But I wouldn't say those two things are mutually exclusive. You should diversify into different types of investments in order to basically smooth out the patterns of your return over time. So you can own some of both. You can also own fixed income securities as well. So there's a plethora of ways you can invest and have a really good diversified portfolio that has muted downside and good upside relative to the market.
I know, back in the day when I living in Boston, there's a big finance company out that way. I won't say their name, but I'm sure you guys can figure it out. They're out of Rhode Island. And at work, they'd always encourage us to, put money in. At 20-something years old, I'm just getting by, and you want me to give you $3 every week to put to this thing or whatever it is. And it was hard. It was very hard. I did do some of it, and I realized I did make my money from there. So it did okay for me. But it was very hard at that moment when you're just getting your first job, you're getting your first apartment, and someone is pressuring you to do this. So how would you sort of, I don't know what the word I'm looking for, coax or encourage someone who's just getting to the workforce?
What I tell people who are starting out is take some time and do a budget. Basically, what your income is going to be. Now you have to calculate what your monthly expenses are and put everything in there, like not just rent and food and and utilities. You have to put how much money you want to, what you're going to spend when going out, how much money you want to spend on clothes every year, travel, whatever it is. Put all that in there, and then divide it by 12, and see what your monthly expenses are. And then you take your income on a monthly basis after taxes, subtract those expenses, and see what's left. And whatever's left, you should start investing that. But it's so the difficulty is having something left because things are so expensive, and then having the discipline to actually do that investing every month, and keep to that budget. Budgets are tough to keep to, but that's what I would do. And that's what I've told people to do over and that are younger and just starting out. So that can be challenging, but it can be very fruitful. And something else I tell people to do, which is something I probably did more informally than formally, but I think it's a formal process of creating your own board of directors, maybe 2 or 3 people who are, you know, a little bit older than you, have more experience and knowledge, so you can have them to kind of keep you accountable as well as give you advice in your life. That to me, it can be a very powerful thing like that. And that works on your financial life, your work stuff, your personal life, whatever it is. But I found that having smart people in my life who are, you know, 5 or 10 or 15 years ahead of me has really helped me gain an advantage.
So I was just thinking about values-based investing, and just wondering how effective that is. You know, people might say, well, I don't want to invest in oil companies. I do want to invest in companies that build wind farms. Do you see that as being effective? Has that become more effective over the years, or is it still better to buy an ETF that just is sort of a basket of companies?
Yeah, I mean, you can buy ETFs that have these characteristics like socially responsible investing or ESG investing. Really, what's gone on there is it really had a lot of backing and following, you know, prior to the past couple of years, starting in like the mid 2010s up until really, you know, probably 2023. There was a lot of pressure to be more socially responsible with investing. There were funds that were generated around that. And the investors have a lot of power because they vote proxies, and proxies basically determine what the company's going to do. So based on your ownership percentage, that's a percentage of your vote. And a lot of these shareholders that have big percentage ownership were asking these companies to be more responsible about how they ran their businesses. And that, you know, that's on the environmental side, the social side, and the governance side. Environmental might be, you know, using more clean water or using cleaner energy. Social could be diversity initiatives, DEI stuff, which we know has kind of blown up over the past 6 months. And then governance is just having independent boards, you know, more representation for minority and women. So those types of things actually were very prevalent up until a couple of years ago, where it kind of, you know, you started to see it fade away a bit. There was a big backlash, and so it's not having as big of an impact as it once did, but it's still out there. You can still invest in socially responsible mutual funds or ETFs that will allow you to have exposure to that characteristic. For instance, we have clients that from a Catholic foundation where we can invest in businesses that make missiles, have anything to do with abortion. So a lot of healthcare companies, defense companies, you can't own those because of that requirement. And basically, you just invest around it. So we can do homework on understanding what exposures a business has that may violate that restriction from the client. And we can eliminate that from our process of potentially investing in it and look for businesses that don't have those characteristics to own them. So it's a little bit trickier, but it's out there. And at one point, I thought it was going to be huge. Like we thought we were going to have to hire people to do ESG in our business. But it took a pretty big backseat as a backlash from, you know, all the wokeness or whatever it's called started to take hold. And it's disappointing, but, you know, I think the pendulum kind of probably swung too far, too fast towards the ESG stuff, and now it's swung back the other way. But I think that ultimately it'll land in the middle.
Well, I actually was gonna tug at that string just a little bit because there's that right wing backlash against DEI and against wokeness, against whatever you want to call it. But then you also have people in the Black community and Latin communities who are boycotting companies, that are not going to these companies, not shopping with them, that are removing some of their investments. So there's a backlash against the backlash. So how do you see this playing out? You know, short term or long term?
Yeah, it's fascinating. I mean, ultimately, the poster child right now is Target, and they've really been taking it on the chin. I think that day when they had the day of boycott for February 28th, they were down 12.9 billion.
Wow.
It's a very powerful thing. I mean, think about the bus strike in the 50s with Rosa Parks. They did that for a year. People don't realize that. Like, that's crippling to a company. And ultimately, I think that economics and incentives drive behavior. And to the extent that shareholders are being hurt by the fact that people will not shop at these businesses because of their DEI and woke stuff that they've kind of eliminated and turned their backs on, there's gonna be a lot of pressure to put that back. Otherwise, people will not shop there, and that hurts the shareholders. So I wouldn't touch that stock right now. It's nuclear waste, and other businesses are going to suffer that way too. I mean, and I think that people are waking up to the power that they hold from an economic standpoint. This wasn't necessarily true a long time ago, but it's true now. And people have gotten used to conveniences and getting their packages in 2 days. You can get used to not doing that again if you want to go against like a Walmart or an Amazon. And I think it's going to have a massive impact, and we're going to find out a lot in quarterly earnings that come out in April and May from the first quarter when a lot of these boycotts started to happen. There's a real following to this, and it's a nice grassroots program that I think is really going to push these boards and executives to rethink what they've done on the DEI side.
Wow.
Interesting to watch.
Yeah.
Yeah.
So Silas, I know you've got a lot going on, and we really appreciate your time this morning. One of the questions we try to ask people, you alluded to this a little earlier, is what did you wish they taught you? And it could be about finance or just in life in general, the thing that you were taught as a young person to move forward.
I think there's so many of those that I think about as I getting up there in age. Obviously, one of them is to buy and hold stocks. I wish I had done that better. Even though I was in finance, I didn't understand it as well as I do now. And there wasn't nearly as much information flow then. So it was a lot more difficult to understand that. I don't think a lot of people really realized the power of that. But the other one, I think, and this is completely unrelated to finances, when you're young, take some time to just enjoy yourself for 2 or 3 years before you start to work in your career. Because, whether you start at 24, 25, or 22, it doesn't matter, but you will never be 24 again. So take 3 months and go live around Western Europe and, work at cafes, fund yourself, or have an adventure that you're going to look back on for the rest of your life that will ultimately, be an experience you'll never forget. Yeah. And will have a massive impact on your life, and, and your career will be there waiting for you because you'll be working for the next 40 years. So I started working 6 weeks after college and haven't stopped. So it's one of those things where I was like, man, it would have been great to just do something, menial for a few years and have a fun time and then start on the grind that I'm on now.
You're having fun now.
Well, I am, but I mean, it's, I haven't had a year off work since I started. I've been working for 35 years.
When do you plan to retire? When do you plan to take those stocks, cash them out, and retire?
Well, I mean, the interesting thing about this business for me is that it's almost not work, because I love the fact that I'm learning something new every day. It's so dynamic. That was what really attracted me to it. It was the meritocracy aspect, and then the fact that I'm basically being paid to learn and make money for myself. And, just by virtue of doing the homework for the clients. And I find it fascinating and something I will be doing the rest of my life. Like, I don't just invest in stocks. I've invested in all kinds of things. And I'm actually looking at 2 right now that are private companies that I invested in. I invested in real estate, hotels. I've invested in veterinary hospitals, all kinds of different things, startup businesses that created efficiencies around buying private cars, the private car market. And there's a million different things. You just have to tap into the right network to find them. And to me, it's just all those things are part and parcel to what this business is to me. It's an incredible learning experience. I keep on top of everything in the world, but it also can be incredibly lucrative as well. So I don't foresee necessarily, I mean, for me, retirement will be no longer managing accounts for clients.
Mhm.
It'll be managing account for me, just my account.
And me
Which,
too.
you know, I mean, and I could see that, you know, 3 to 5 years, maybe. I don't know. I don't really have a time frame in mind. But I think as long as they're happy, I'll do this for the clients. And then you know, when they decide not to have me, I'll do it for myself.
Yeah, we know that you've got stocks to trade and places to go. So, you know, we'll wrap it up here. But thank you so much for your time. We really appreciate it. We appreciate all the knowledge you shared. And we hope we'll get the chance to talk to you again.
I would love to.
Thank you so
Would
much.
love to.
Thank you.
Thank you, guys.
And for folks who are listening and watching, feel free to send us your questions. We always like to have your questions. It fuels us when we think about each episode and when we talk to the guest. And with that said, we will see you on the next episode of Things They Don't Teach Us. Take care.